All right, good afternoon or good morning, everyone. Thank you so much for joining our CE webinar today. It is 12 o'clock sharp here on the East Coast, so we are just going to give everyone another 30 seconds or so to come on in and get settled, get familiar with this dashboard, and we will kick it off right around 12:01. So just bear with us for a minute, get settled, and then we'll kick things off. Thank you so much for being here. All right, we're at 12:01 here, Meredith. I think we should kick things off.
I think we're ready to go. So like Eddie said, welcome everyone to our webinar, Open Enrollment Compliance Explained, Plan Documents, Filings, and Avoiding Costly Mistakes. For those that are new to our compliance series, welcome. And for those that are returning, welcome back. We're thrilled to have you with us today for part 3 of our 2025 compliance series. I honestly cannot believe we're already at another open enrollment season. It just seems crazy to me. And as you know, open enrollment is a pivotal time of year, and with numerous moving pieces, sometimes a lot of moving pieces, from plan documents and filings and required notices, it is crucial to get it right. This webinar is CE accredited and SHRM certified, so we're excited to bring you this timely and practical guidance to both benefit brokers and HR professionals. As regulatory scrutiny increases, particularly around documentation and disclosure, even minor missteps can result in substantial financial penalties. Whether you're advising clients or overseeing internal HR processes, the insights that we will share today can help you steer clear of common compliance pitfalls and strengthen your value as a benefits expert.
Well said, Meredith. Like Meredith said, this session is really built for brokers, consultants, general agents, and employers, because really, no matter what your role is, you are part of the compliance process. So our goal today is ultimately to give you clear, actionable strategies to help you, your clients, and your employers stay compliant during the open enrollment season and throughout the course of the year.
Perfect. So by way of introduction, my name is Meredith LaRoe, and I'm Clarity's Compliance Director. One of my main focuses is monitoring regulatory changes and providing best practices to help our partners stay ahead of the ever-evolving compliance landscape, especially during high-risk periods like open enrollment.
And my name is Eddie Larned. I am Clarity's Senior Vice President of Sales. I've worked with brokers, general agents, and employers for many years, helping them make sense of complex benefits requirements and really trying to help simplify solutions and maintain compliance, especially when it comes to open enrollment strategies where we have to keep compliance top of mind.
All right, so before we dive in, let's get the housekeeping items out of the way so that you can get the most from today's session. First, all participants are muted to avoid outside distractions. This session, as a reminder, is approved for 1 CE credit for benefit brokers and 1 PDC credit for SHRM certified professionals. If you're here for credit, please ensure you participate in the polls and stay for the whole session, as that is part of the CE requirement. If you have any questions, please submit them in the Q&A box located beneath the media player, and we'll be sure to save time at the end of the session to address any content-related questions. Slides and resources can be found in the content widget on the right-hand side of your screen. And of course, the webinar is being recorded, and we'll send the recording link to all registrants after the session. CE certificates will go out within 3 to 5 business days if all participation requirements are met, and SHRM participants will receive their PDC details by email after the webinar is concluded.
Great, and I've seen we've already had a couple of comments in the Q&A section. We do have folks behind the scenes who are going to be answering those. Of course, like Meredith said, at the end of the webinar, she and I will answer as many as we possibly can. But if you're having any technical issues, enter them in the Q&A, and our team behind the scenes will help you out. Like Meredith said, 1 hour, and we will share the slides after. We do have a couple poll questions that we'll talk about. We please answer those in the actual survey widget, which will pop up right in the middle of your screen instead of in the Q&A. And I'll repeat that again as we get to that point.
Yeah, and I'm sure there might be a lot of questions after this session. We may not be able to get to them all prior to the conclusion of today's webinar, but we will be sure to follow up with you after the session with responses to your questions. So let's take a look at what we'll walk away with from today's session. First, we'll outline the core compliance responsibilities employers and brokers must address during open enrollment. Then we'll walk through the plan document landscape, what's required under ERISA, how to manage SPDs and RAC documents, and where employers can often fall short. We'll also cover all the filing and notices tied to OE, including cafeteria plan requirements, from 5500 filing, COBRA, and ACA, and flag where errors can often occur. We'll touch on non-discrimination testing requirements and explore common compliance mistakes, including real-world scenarios, and how brokers and TPAs can collaborate to mitigate risk. And finally, we'll look at some emerging regulatory trends on the horizons that you can stay proactive year-round. Sound good, Eddie?
Yeah, let's do it.
All right. All right, so let's hop into part one, which is the importance of compliance during open enrollment. So let's kick things off with talking about why open enrollment is such a compliance flashpoint. Obviously, this is one of the busiest times of year for HR teams and brokers. You're so busy. You're updating benefits, finalizing rates, communicating plan changes, and collecting new elections. And with all of that activity comes an elevated risk of compliance slip-ups. The Department of Labor, the IRS, HHS, and EEOC all play a role in benefits oversight, and they're watching closely. A small error in a summary plan description or a missed COBRA notice or misfiled Form 5500 can result in significant penalties. Employers ultimately bear responsibility for compliance, but obviously brokers play a key role in guiding them. From reviewing plan documents to flagging regulatory deadlines, this is where your strategic value really comes into play. And it's not just theoretical. OE season is a prime trigger for audits and investigations, especially when documentation is outdated, inconsistent, or incomplete. And that really is why staying ahead of compliance isn't optional. It is really essential.
Yeah, and we always say, and this will sound incredibly cliche, but I'll say it anyways. It's kind of like, open enrollment is like trying to renovate your house during a hurricane, right? There's so much going on, whether you're switching payroll platforms, Ben admin systems, you're building integrations, you're dealing with a big medical increase, you're going to market on all your other benefits, your ancillary products. But this is really when the cracks do show up. And if you're not really tight on compliance, you're not buttoned up, this is when things fall through the cracks. And to your point, Meredith, that's when penalties come out. And as we're going to discuss today, these penalties are not small. So easy way to avoid headaches is having a checklist and some of the other takeaways that we're going to talk about in today's into the next hour.
Absolutely. Yeah, it's a wild time of year for sure. So part two, let's dive into some plan documents, which is the foundation of open enrollment compliance. So let's start with the basics, right? So the plan document serves as the foundation for open enrollment compliance and really the foundation for the plan. Under ERISA, every employer-sponsored health and welfare benefit plan must have a written plan document, even if it's a fully insured plan through a carrier. And that may surprise some employers, but it is required. So the plan document formally outlines the structure of each benefit that's being offered, including eligibility rules, coverage details, funding arrangements, the process in which claims are handled, and the responsibilities of all parties involved. It's not a marketing piece or handout. It is truly a legal document that is signed and executed, and it must exist in writing. It's also one of the first things a regulator will ask for in the event of an audit. If the plan document is missing, incomplete, or out of date, that is truly a compliance violation, full stop.
Right. And just because you have like a carrier booklet doesn't necessarily mean you're covered, right? Like the DOL doesn't consider that to be a full-blown ERISA plan document. And I think we see a lot of employers make that mistake, especially smaller ones, just not having a good understanding of what is actually considered this legal plan document and what do I need in order to be fully buttoned up in case of an audit.
Yeah, and as we'll mention a few times over this presentation, the carrier booklet is likely not going to cut most things under ERISA requirements. So really the plan document, again, is the foundation, the legal foundation for these plans. So let's cover the SPD next, or the summary plan description. We in this world, as you know, we talk in a lot of abbreviations. So SPD is short for summary plan description. And under ERISA, it requires employers to distribute an SPD for every benefit plan that they sponsor, which includes things like medical, dental, vision, life, FSA, HRAs, all of them. And it can't just be legal jargon. The SPD is required to be written in such a way that the average participant can understand what's being communicated. On top of that, there are 5 core components that must be included in the SPD, and that includes the plan name and the plan sponsor, the eligibility rules, meaning who's eligible, when are they eligible, and under what conditions, a summary of the benefits provided under the plan, what the claims process is, as well as any appeals procedures, and the participants' ERISA rights. Timing is also critical when it comes to the SPD delivery. Participants must receive the SPD within 90 days of becoming covered under the plan, or within 120 days of a new plan's creation. Updates, amendments, and restatements must also follow specific timelines, which we will touch on shortly. One of the most common audit flags: employers never issue the SPDs, or they assume carrier materials count. As I've said earlier, the carrier materials often don't count when it comes to an audit or the requirements of delivering the SPD to participants.
Yeah, I have 2 comments on that point, Meredith. I mean, first off, you mentioned every kind of ERISA qualified benefit. From a lot of meetings I've been in, open enrollment meetings over the years, you see a huge emphasis on here are the medical SPDs and the medical plan documents, but you very rarely see it, or I should say less common, do you see folks distributing the ancillary products and the life and the dental, and never mind like an FSA or an HRA plan document. A lot of times it's like, oh, I posted it here. It's posted on the internet, or it's posted on the Ben admin system for you to go see. But that seems a little bit different from like, did you actually receive it? Was it actually distributed? Would you agree that those are not necessarily the same thing as far as just making it available versus I have distributed it and I know that people have received it?
Yeah, I think in general, best practice would be obviously to make it available. Make sure people know that it's there, and make sure that you're tracking delivery of that document, and at least that they've opened it and acknowledged receipt of it. I think that is best practice in the event of any type of audit, that you have those bases covered. I think when we talk about this, not just simply adding it to your intranet and no one knows it's there, is probably going to cut it.
Yeah, thanks.
No problem. Okay, sorry. All right. So what happens if an employer has multiple benefit plans from different carriers? Say they have a medical plan, a dental plan, a vision plan, and a life plan, and each one comes with a carrier booklet, but that doesn't fully meet ERISA's requirements. Well, that's where the wrap document comes in. A wrap document allows employers to wrap their insurance contracts or benefit summaries with the ERISA required legal language that's missing from most carrier materials. The wrap document serves 2 big purposes. It consolidates multiple benefits into a single ERISA plan, which simplifies a lot of reporting and filings, particularly the Form 5500, which we'll talk about in a little bit. It also ensures that employers meet the disclosure requirements for SPDs and plan documents by adding these missing pieces, such as ERISA rights, plan sponsor details, and claims procedures. There are a lot of required notices under ERISA that need to be provided to participants on an annual basis, or in regards to COBRA on an event basis. And the ERISA wrap document provides all of those necessary notices in one concise document. However, this is key. A wrap document must be tailored to the employer's actual benefits and plan design. A generic wrap template just really will not cut it in terms of ERISA compliance. When done correctly, a wrap document simplifies compliance and greatly, in my opinion, reduces risk. When done wrong or skipped altogether, it can create confusion and inconsistency across documents that may not hold up in an audit.
Yeah, and Meredith, from my side of the world, on the sales side, we get asked by brokers or general agents or HR professionals all the time, hey, do we actually need an ERISA wrap document for our client, for example? And it's like, Well, you could be compliant without one if you're really buttoned up. You have that checklist, you have every piece of documentation that you just mentioned, every SPD, every plan document, you're up to date with all the legislative updates. Yes, you could be compliant, but having an ERISA wrap document that's actually created properly almost guarantees your compliance. And I remember I saw this stat a couple of months ago in an article that 92% of all employers in America are out of compliance with ERISA in one capacity or another. So why take that risk when a wrap could just kind of put it all in one place, one document? You don't have to worry about it for the rest of the year. So that's kind of the feedback that we provide, or the guidance we provide when we get that question.
I think it's the easiest way to meet the requirement or the disclosure requirements under ERISA is to have the wrap document, the one-stop shop, and it puts it all in one place.
Yep.
It's a shocking statistic that you just shared, Eddie. Thank you.
Yep.
So we've talked about what plan documents and SPD should look like. Now let's talk about where employers can commonly go wrong. First, it's not unusual, especially for smaller mid-sized clients, to have no formal documents or SPDs in place at all. And they may assume that their carrying materials are enough. Second, we often encounter outdated documents. Perhaps the plan documents were written before the ACA rules took effect, or hasn't been updated to reflect COBRA model notices, COVID era extensions, or mental health parity. Another big one is inconsistent language between the plan document, the SBD, and the carrier booklet. If those materials don't align, for example, on eligibility or termination rules, the employer is exposed during an audit or a participant dispute. And even when wrap documents are used, we sometimes see them copied from a generic template, again, with no customization. If the document doesn't reflect what the employer actually is offering, it may not stand up in a DOL investigation. As a broker or consultant, flagging these risks early can help avoid costly mistakes down the road.
Yeah, those are all good points, Meredith, and even real world example from this week that you and I worked together on. Working with a broker partner, they're saying, "Hey, I've got this ERISA wrap document from this administrator, but I'm not sure if we need a new one." So we said, "All right, send us over what you got, and we'll take a look at it." First thing I noticed is it said effective January 1st, 2022. So Meredith and I kind of went back and said, "Hey, have you changed any plans since then? Any carriers or anything?" And they're like, "Oh yeah, we've got all new carriers." So our immediate reaction is, yes, you do need a new one. We need to get those new carriers, new SBCs in there, new plan documents. And that's just on the plan side and the carrier side. What about some of those legislative updates that seem to be happening every year or every couple years? And certainly whenever there's a new administration, there's new changes to the regulations and the legislation. So there's two sides to that. And unlike Section 125 POP document, which we will talk about in a little bit, which I think can generally be good for multiple years if there aren't any major legislative changes and you haven't totally changed your benefits offering. With ERISA, that's not really the case. Any changes to your offering that impacts your ERISA plans, that document needs to be updated. And I think that's something that a lot of folks don't realize.
Yeah, it's not just a set it and forget it type of document. It really is a living and breathing document, right? As changes are made to the benefits landscape, as changes are made to an individual company's landscape, that document does need to be amended and does need to be restated. So it is important to at least check in on it, look at it at least once a year, and report any changes that need to be updated.
Yep. All right, so we have our first poll question here. So let's get everyone warmed up, see if you've been paying attention to the content that Meredith has been going over. So what I'll do here is I will read this question and the answers and give everyone 20 or 30 seconds to go ahead and respond. And please remember, use the pop-up poll widget that should be appearing in the middle here. And remember, if you are here for a CE credit, your participation in the polls is required. So please don't skip it. And again, just don't put your answer in the chat feature. Not a big deal, if you will, but we want to be able to examine the group's responses as a whole. So this question is, which of the following is required in a summary plan description, an SPD, under ERISA? A list of all employee birthdays. B, an outline of the ERISA rights of participants. C, a copy of the employer's company mission statement, or D, a chart of average provider reimbursement rates. So on my side, I'm showing that 39% of our attendees have responded. I'm going to wait until we're over 50% and make sure everyone had sufficient time to go ahead and answer this. And then let's check out how you guys responded. And as I say that, we are over 50% of responses. So let's check it out. All right. That was an easy one, I guess. We gave you guys a layup. You nailed it. At almost 97% of your responses were an outline of the ERISA rights of participants. So good job paying attention. You guys nailed that one.
Or we just have a really smart bunch here today.
Yeah. There you go.
Which I love. Okay. So we always like to wrap things up with giving real life scenarios that we've seen, obviously that we have seen more than once. So a mid-sized employer was selected for a DOL audit. One of the first requests, the SPD for their group health plan. The employer confidently handed over the carrier booklet, thinking that that was sufficient, but it wasn't. And they had no wrap document, no standalone SPD, and no documentation that anything was ever distributed to employees. Their plan information was scattered across PDFs, intranet posts, and open enrollment emails, none of which met ERISA's standards. The DOL flagged them for noncompliance. They were forced to create compliant plan documents retroactively, distribute SPDs, and document delivery of those plan documents. On top of the financial cost that this had, there was reputational damage, both with employees and their broker. It's a perfect example of how something that feels like an administrative detail, or really like administrative burden, can become a major compliance issue if it is ignored.
Yeah, definitely a tough look for how your employees perceive, leadership and HR and the broker partner. Not the best. And the kicker is, all of that could be avoided with an ERISA wrap, which is only a couple $100 to $1,000, depending on, other factors. If you're doing 5,500 and POP and things like that, we're not talking about, something that costs $10,000 to do. It's a lot less than that and can just help you avoid a lot of these headaches. So always good to apply a real life scenario to this.
Absolutely. Totally agree. All right. So compliance filings related to open enrollment. Next slide, please. So let's kick this section off with Section 125 plans, also known as cafeteria plans. These are options that allow employees to make pre-tax elections for benefits such as medical, dental, vision, and their FSA contributions. The IRS requires that employers maintain a written Section 125 plan document separate from the ERISA wrap or the ERISA SPD. It must outline the benefits included, who is eligible, and the rules for making or changing elections. A key compliance risk during open enrollment is improper handling of mid-year election changes. Outside of OE, changes can only be made to elections if there's a qualifying event, such as marriage, birth, or loss of other coverage. Employers must honor special enrollment rights under HIPAA, and all elections must be prospective. No backdating allowed, even if the participant signs the form late and hands it in late. If the Section 125 document is missing or ignored, the IRS could disallow pretext status, which could trigger income and payroll tax liability for both the employer and the employees.
That's an important one too, right there, Meredith. Imagine being at the end of the year, you've contributed $5,000 or $10,000 pre-tax for your various benefits and insurance plans, and now all of a sudden you're told, oh, you have to pay taxes on that money because your employer doesn't have a POP plan on file, which is even cheaper than the ERISA plan that we talked about. So that's an important one. The no retroactive status, I think, is an important one. And the other thing is, I think a lot of us assume that this is a function of the payroll company and that the payroll provider will automatically provide it or will proactively try to sell it, which very well might be the case with a lot of payroll platforms, but definitely not all. I'm always surprised when it's like, oh, we just moved over to this payroll company. They didn't even bring this up. Should we, do we need this? And it's like, yes, you definitely do. You might have one from a year or two ago that could totally be compliant. Like we said, this one is a little more static, I think, than the ERISA wrap. But, it's definitely something that I don't think is top of mind to everyone, but must be in place if you're going to make those pre-tax contributions through payroll, which is kind of a no-brainer.
Absolutely. If you want to take something pre-tax, you need to make sure you have a plan document in place that's been executed and dated. Executed means signed. So definitely something to keep keep in mind. So now let's talk about Form 5500, which is required for certain welfare benefit plans. In general, employers must file Form 5500 if they sponsor a health or welfare benefit plan with 100 or more participants on the first day of the plan year. This includes plans like medical, dental, vision, life insurance, and disability. Filing is also mandatory for any plans funded through a trust, regardless of size. Welfare plans with fewer than 100 participants that are either unfunded or insured are typically exempt from filing, along with government entities and church plans. The deadline is very strict here. It's the last day of the 7th month after the end of the plan year. So for a calendar year plan, that means that by July 31st of the next year, the 5500 filing is due. Extensions are available, but must be requested and filed before the initial filing deadline. If you request an extension after the deadline, the IRS is not going to grant you that extension. And penalties for non-filing or late filing are exorbitant, honestly. It's up to $2,670 per day for each late or missing form, and that's per plan. One way that obviously we recommend to streamline this is by using the wrap document, which wraps all your plans into one ERISA plan and allows for multiple benefits to be filed under one single plan for 5500 purposes. This ultimately reduces filing volume, simplifies administration, and ultimately simplifies costs as well.
Yeah, those are steep penalties, especially being per day per plan. So you're talking about, that almost $3,000 times if you have 4 ERISA plans per day.
Absolutely.
I mean, that is significant. And I hate to say it, but in my 15 years of working in pre-tax employee benefits and compliance, I have seen groups get hit with pretty massive penalties, even after that kind of delinquent filing. And someone gets blamed. And I've seen brokers lose BORs over it. I've seen HR managers get terminated over it. You hate to see it, but a business owner who's trying to run a business and has profit margins to worry about is going to be pretty upset when they have to pay the government fees for something like a 5500. So definitely something that needs to be top of mind.
Yeah, and there is delinquent filing programs that are available through the IRS, but even with those, the penalties can still be steep. It's discounted, but it's still expensive, depending on how late the filing is and how many employees were in that plan. They can still be pretty outrageous. All right, so let's touch on COBRA next, which is a significant compliance risk area during open enrollment. Employers, as we know, are required to provide 2 key notices. The general notice, which must go out to all covered employees and spouses within 90 days of enrollment in a qualified plan, and the qualifying event notice, which must go out 14 days when coverage is lost, such as due to termination or reduction in hours, and gives them the right to continue their coverage under COBRA. During open enrollment, COBRA participants must also be included in communications, and they must receive the same election materials, deadlines, and plan updates as active employees. If the employer changes the plan, for example, adjusting premiums or benefits, COBRA participants must be offered the same new plan options. We've seen compliance failures here lead to DOL investigations, class action lawsuits, and IRS penalties, especially when those notices are late, incomplete, or not properly tracked.
Yeah, I think a lot of times folks think of COBRA compliance, they're primarily thinking of that, qualifying event notice, right? When someone terminates or has some sort of qualifying event. But a lot of times that general rights notice that you said has to be sent out within 90 days of the plan enrollment, that kind of flies under the radar. And speaking of lawsuits, I always think of the famous example of that McDonald's franchise that was hit with massive lawsuits and penalties because they weren't sending out the COBRA notices. Someone didn't have coverage, had a heart attack, and now you're dealing with that whole mess. So I think a key when it comes to COBRA is also automation whenever possible, and integrating, your COBRA administrator with a Ben admin platform or with a payroll platform, so that those notices, both the general rights notices and the qualifying event notices, go out automatically, and you don't have that chance for human error. You don't have an HR manager who's out on vacation for 2 weeks and then it slips through the cracks, or you don't have one where you had 5 terminations in one day and 4 of them were processed manually and 1 wasn't, and then you have issues. So leveraging, I think, technology to automate those processes, take it off the plate of HR, can be definitely advantageous and help you avoid some of these headaches.
Yeah. And just like the 5,500 filing deadlines, the COBRA timelines are very strict as well and very black and white. So leveraging technology to do that administrative work for you is always going to win, in my opinion.
Yeah, and someone who needs coverage for themselves and their family and doesn't get the COBRA letter, they're not going to hesitate to call the DOL. No chance.
No, absolutely. Seen it.
Yep.
So here's a real world example of how things can go sideways when COBRA is treated like an afterthought. A mid-sized employer made some changes to its health plan during open enrollment, including new deductibles, a different HSA option, and there was a slight rate increase as well. Active employees received all the materials through the carrier's platform, but the HR team forgot to send any materials to the COBRA participants. One former employee found out weeks later and filed a complaint, and the Department of Labor got involved. The new employer was found non-compliant under COBRA. They had to extend the enrollment window, reissue updated notices, and allow retroactive elections. And they also incurred a penalty and accumulated legal fees. The kicker, all of this could have been avoided with one spreadsheet and a mailing list. And that's why brokers and TPAs can be so valuable during open enrollment. You help employers spot and fix these gaps before they become legal issues, ultimately.
Yeah, and it's always the little thing that you think is handled or someone else is handling that comes back to bite you. And let's be real, COBRA folks, people formerly your employees no longer, are not really top of mind during open enrollment. You're fielding a million questions from the active population. But from a legal standpoint, those people do need to be top of mind. And again, it's usually not a random DOL audit. It's usually resulting from a complaint from someone who didn't get the materials for open enrollment, didn't get the plan options, didn't get a COBRA letter, whatever the situation may be.
Absolutely. Yeah. All right, let's touch on ACA compliance, which directly intersects with open enrollment, especially around affordability and IRS reporting. During OE, employers set rates and benefits that affect whether coverage is considered affordable or non-affordable under the ACA. The IRS provides 3 safe harbors for providing affordability or proving affordability. One is the W-2 wages, the second is rate of pay, and third is federal poverty line. The affordability thresholds are updated annually, so employers must verify that their lowest cost minimum value plan meets the standard before January 1st of each year. For 2025, that's 9.02% of someone's wages is considered affordable, and this is adjusted every year. Then there's reporting. Employers must submit forms 1095-C and 1094-C to the IRS and provide copies to employees. E-filing deadline for these forms is March 31st. Common errors include using incorrect codes for offers of coverage, missing filing deadlines, or incorrectly tracking affordability across different pay groups. Since all of this flows from OE elections, it's critical to get the data and plan design right now, not in February when filings are due or close to being due.
Yep. Once open enrollment is over, the ACA reporting clock begins ticking. And as everyone on this webinar will agree, trying to fix affordability errors after W-2s go out is not fun for anyone. That's a huge pain in the neck. So good to avoid that ahead of time for sure.
So many deadlines.
Yep. All right. So next poll question here. This question is, which of the following employers is required to file a Form 5500? You can answer this as A, a company with 45 employees offering fully insured medical coverage. B, a company with 150 employees enrolled in a self-funded dental plan. C, a company offering only voluntary vision coverage with fewer than 100 enrolled. Or D, a company with 75 employees enrolled in a fully insured plan. So we will go ahead and give everyone a chance to respond. We'll give you another 15 seconds to 30 seconds. We've got almost 400 people here today, so looking to get at least 50% of these answers across and make sure everyone can qualify for that CE credit if that's what you're looking for. So we'll just give everyone a second here.
creeping up there.
Yep.
And a few more.
All right. I think we're good. So let's check out the responses. And you guys got this one right as well. So the correct answer is B, a company with 150 employees and a self-funded dental plan. The 5,500 filing threshold is typically 100 or more participants on the first day of the plan year, and self-funded plans almost always trigger the requirement. Fully insured, smaller plans, or voluntary only offerings generally don't need to file, but it always depends on the plan structure and the funding and, of course, the number of people enrolled.
Absolutely. Again, like I said, smart bunch here today, Eddie.
Yeah, 2 for 2.
Let's jump into my favorite, discrimination testing for part 4. So it's my favorite, but I don't think it's anyone else's favorite. So
yeah, you're alone there.
I think I'm the cheese that stands alone for sure. It's definitely not the most glamorous OE test, but it is required and it is critical. There are 3 areas required for testing under ERISA. One is Section 125 plans, which must show that pre-tax elections don't favor highly compensated or key employees. Section 129 or DCAP testing plans are obviously we're testing for discrimination against dependent care plans, and then 105H plans, which apply to self-funded medical plans, which does include the HRA, which I think some people are surprised by, but the HRA does need to be tested. It does fall under Section 105H, and these tests also test for discriminatory eligibility and benefit offerings. These tests must be run and must pass before the plan year ends and cannot be run after the plan year has concluded. Unlike 401k testing, these types of tests under ERISA, like there is no backdating of changes or corrections. It has to be run and it has to pass before the plan year ends. The testing is ideally done after elections are finalized, but before they take effect or as close to the plan renewal date as possible. This gives enough time. It means that there's less payroll deductions if corrections need to be made. There's been less time for claims to be incurred, and there is a lot more time to make that corrective action. If employers fail to address testing issues and they don't correct them, the affected employees, which typically are the executives or the leadership or your highly compensated employees, may find their benefits taxable, and that is not a fun conversation you want to have with your CEO. So, and nobody wants to explain that in January. Nobody wants to explain that to the higher ups at the company, nobody. So brokers and TPAs can play a huge role here, reminding clients to run the test early, reviewing results, and suggesting corrections like plan design changes or taxable refunds if needed.
Yeah, I think you mentioned a couple important pieces there, Meredith. Number one, we get the question all the time, oh, do we actually have to do this? The answer is yes, you do. And I think the other key point you make there is that, it's a very uncomfortable and unpleasant conversation to have after the fact. So we do suggest that employers run this testing right after open enrollment, but before the plan year starts, in case you do fail and you need to make some adjustments, and you can get out ahead of it. And you have that data because people have made their elections. So you can actually run the tests and see if they're going to pass or fail. Like we said, make adjustments. Maybe you, highly compensated employees, you're capped at $3,000 on the dependent care account instead of $5,000. And next year that's $7,500. And you can make those adjustments to allow you to pass. But sometimes I talk to HR managers and they're like, look, I don't want to do that because then I could have egg on my face, because what if we do fail and then I have to go tell either the whole company or the highly compensated employees, you can't participate. So if you do find yourself in that sort of situation, I think as an HR manager, you could kind of proactively get a feel for, get a pulse for, do a little survey of understanding of who's going to participate, who's going to max this out, work with your third-party administrator and say, hey, we've only got 22 employees. I've only got 3 people I think are going to take the dependent care account, and 2 of them are highly compensated employees. What do we do? That way you're kind of getting out way in front of it even before people go through open enrollment and make their elections. Now, given in this scenario that I'm talking about, you're kind of giving it your best guess and you're, assuming what people might do. But again, if you find yourself in that situation, it might be worth at least setting the expectation with leadership, executives, highly compensated employees. Hey, depending on how things fall and how the elections come in, you may or may not be able to enroll in this benefit. That's a good way of getting in front of it.
Yep. I absolutely agree. And we've done that quite a few times where we pre-test even before the benefit's even offered to see if it
Yep.
may result in some issues down the line.
And in my experience, a lot of times FSA and Section 105 HRA, those usually pass without an issue. But like I said, the dependent care, a lot of times, just because it's a smaller population of people that are participating in it, that's often the plan I see fail. But like we said, there's corrective action that can usually be taken to allow people to pass.
Absolutely. Absolutely. All right. We're at part 5 already. Avoiding common pitfalls in real world scenarios. So we've covered a lot of what employers should do during open enrollment. Now let's look at some common mistakes we see when those best practices aren't followed. One of the biggest, outdated or missing plan documents. SPDs or wrap documents that haven't been touched in years or never existed in the first place. Another issue is failing to distribute required notices like COBRA notices, summary of benefits and coverage or SBCs, and even SPDs. If the delivery method isn't compliant, or the documentation isn't retained, it can be a problem. Filing mistakes are also common. Form 5500 deadlines are often missed, or employers fail to realize that they are required to file in the first place. Then there's data inconsistency. What's in the OE system may not match payroll or the HIRS system, which causes issue when it's time for ACA reporting or claims adjudication. And perhaps the most dangerous assumption, believing that the TPA or carrier is handling it all. Compliance is ultimately a shared responsibility, and gaps in oversight can cost employers dearly.
Yep, we all know what happens when you assume. And back to what Meredith said earlier, I think just having a checklist, but also just posting these things on an intranet or a Ben admin system doesn't necessarily mean they've been received, reviewed, delivered. I think there needs to be some tracking of some sort or proof just to really CYA here and make sure that you're all buttoned up in case of an audit. So really making sure that it's actually been distributed and received.
Yeah, absolutely. And while some of this may sound scary, the good news is that most of these OE compliance mistakes that we've talked about are completely avoidable with the right support. For brokers, that's where you can step in and add tremendous value. Start by reviewing your client's plan documents to make sure that everything is up to date. If you notice an SPD that hasn't been updated since 2019, that's probably a red flag. Offer a simple compliance checklist, as Eddie has mentioned, an OE timeline that includes reminders for COBRA notices, non-discrimination testing, and 5500 filing. Work with your TPA partners to confirm who is responsible for what, who is issuing the COBRA notices, who's filing the 5500, who's managing the cafeteria plan documents, etc. Don't assume it's being handled unless you've agreed and seen it in writing. And most importantly, don't just be a renewal negotiator. Your clients already expect you to help with pricing and plan design. What sets you apart is becoming their compliance quarterback, the person making sure the whole team is aligned and nothing falls through the cracks.
Yeah, and I think oftentimes and somewhat unfairly, employers expect brokers to be experts at absolutely everything. And that's just not realistic no matter what you do. And so I tell brokers all the time, look, you don't have to be a lawyer when it comes to ERISA. You don't have to be the be all end all expert. You just have to know enough to be dangerous and know enough to ask the right questions and to spot when something is off. That's where I think the trust is built and the value is established, even beyond just processing the renewal. So catching those types of things, bringing that checklist to the table, sitting down and making sure that everyone has a clear understanding of who's responsible for which aspects of the compliance checklist.
Completely agree. So let's close out this section with another real world example that really hits close to home for, again, many mid-sized employers. A company with 125 enrolled employees offers self-funded dental and vision plans. They had a wrap document in place, but unfortunately it was outdated and never appropriately filed or disclosed. The HR team didn't realize that they had to file Form 5500 for those benefits, and the broker just assumed that the TPA was handling it. Come to find out, no one was. The IRS eventually caught the error and issued a penalty of $2,670 per each day for each plan that the filing was late. It totaled more than $30,000 before they filed under the delinquent filer program. The employer paid the penalty, cleaned up their documentation, and then quickly and promptly switched both their broker and their TPA. It's a great example of how simple communication gaps can lead to real financial and reputational fallout.
Yep, absolutely. All right, looks like we have our last poll question on the day here, and then I'll hand it back to Meredith to take us home. What is the most common compliance issue employers face during open enrollment? And you can answer this one as A, offering too many plan choices, B, failing to distribute required notices or documents, C, filing W-2s late, or D, forgetting to update employee addresses. So we'll give everyone a few seconds to go ahead and review this and respond so we can make sure folks qualify for the CE here. Then we'll check out your results, see how we did, see if we can go 3 for 3 with the majority of our attendees here. And then we just have a few final slides left to take us to the top of the hour. All right, we're already over 58%, so let's go check this out. Wow, nailed it. So the answer was B, failing to distribute required notices or documents. So could have just hit B on all 3 questions here and you'd be at 100%, but this was by far I think our most successful response here. So congratulations, that is correct.
It's like answering every question with George Washington in history class.
That's right.
You're bound to get a C. You're bound to get a C, right?
There you go. Yep. So again, just one thing to add to that. It's not just about sending, but it's tracking delivery. Courts and regulators want proof that the employees received the correct information at the right time. It includes things such as the COBRA notices, the SPDs, the SBCs, and occasionally even just the basic enrollment materials. So great job, everyone.
Again, look at Smart Group here this week. This quarter, this webinar. So let's look at part 6, which is emerging regulatory issues. So kind of before we wrap up, let's take a quick look ahead at some of the regulatory trends that could shape OE compliance in the coming years. First, enforcement of transparency and coverage is ramping up. Employers and carriers must publish machine-readable files and cost-sharing disclosures to comply, and we are seeing more scrutiny from regulators. Then there's RxDC reporting, which stands for Prescription Drug and Healthcare Spending. This is an annual reporting requirement through CMS that includes detailed pharmacy and cost data. It's new and complex and here to stay. We're also seeing more mental health parity audits, especially from the DOL. Plans must demonstrate that mental health and substance use disorder benefits are comparable to medical and surgical coverage, and it's not just about comparable copays. And don't forget about the ACA affordability thresholds. As a reminder, these shift every year, and early signs point to tighter standards in 2026, which would impact OE planning and contribution strategy. The key takeaway is that compliance is an OE issue, but it's not just an OE issue. It is a year-round responsibility. Staying ahead of changes now will make open enrollment and beyond far less stressful down the road.
Yep, like we talked about, important to be aware of a lot of these legislative changes. You know, the mental health parity is pretty recent. You had the One Big Beautiful Bill this summer that got passed, increasing the dependent care maximum to $7,500. So anytime a new administration comes in, but even outside of that, there's oftentimes a lot of these changes to be aware of. So always an evolving environment here.
Always an evolving landscape for sure. Sometimes it makes my head spin with how many things are changing, especially, with new administration in the door. So,
yep.
All right. So conclusion and action steps. So next slide, please.
Sure.
Okay, so your action plan, right? So before we move into the Q&A, let's recap what we covered and leave you with an action plan for OE compliance. First and foremost, make sure your plan documents and SPDs are current and compliant. This is one of the most common and avoidable audit triggers. Confirm whether your clients or yourselves are required to file Form 5500. Again, this typically is for individuals in a health plan with 100 or more participants on the first, in a benefit plan with 100 or more participants enrolled on the first day of the plan year, or if your benefits are funded through a trust. Ensure that notices are distributed on time, including COBRA notices, whether that be the general rights or the specific rights notice, SBCs, SBDs, and any other ACA-related forms or notices that are required under ERISA. Run discrimination tests early, especially if there are highly compensated employees or executive-only plans that are being offered. And coordinate with CPAs and carriers. Don't assume everyone is handling compliance. Clarify who's responsible for what and get it in writing. And finally, stay on top of regulatory changes like RxDC, transparency in coverage, and mental health parity. Compliance doesn't end in November. It doesn't end in December. It is a year-round effort.
Well said, Meredith. And we've said the word checklist probably 10 times during this past hour. I think this is a pretty good outline of what your checklist could look like. So really good things to highlight as you're approaching Q4. It's all our busy season. And I think a quick half-hour meeting with our clients and our partners and our brokers to review a couple of these things can definitely go a long way and eliminate a lot of headaches down the road.
Definitely agree. Definitely agree. So I want to thank you all for joining us today. We'll be sending out an email shortly with a link to the recording and all referenced resources. If you participated in the required polls, a lot of you did, and a lot of you got them right, and you stayed for the whole session, your CE certificate will arrive in 3 to 5 business days. SHRM certified professionals, you'll also receive your PDC credit information via email after the session. And we will follow up soon with the dates and content of our next compliance webinar, which I'm excited about. And with that, we will open it up to questions for the next few minutes or so.
Love it.
And I want to thank you for joining.
Yeah, thank you so much, everyone. And we've got a ton of awesome questions in here. I will reiterate what Meredith said because it's the first question I'm looking at from Jennifer. If you have more webinars, I would be interested in attending. Like Meredith said, this was our 3rd this year, and we're hoping to have another 2 or 3 next year in 2026. We're going to probably not do one in Q4 when we're all crazy busy, but we'll definitely be back at it in the new year with some more content. So thank you for that comment, Jennifer. We appreciate it. Let's get to some of the content here. Meredith, how does the plan document need to be changed related to the FSA for dependent care? Is that as simple as just adjusting the IRS maximum from $5,000 to $7,500, or is there anything else you recommend?
No, for dependent care, with the One Big Beautiful Bill, the change to dependent care is that once the cost of living comes out, I think sometime in the fall, November, or October area, dependent care will increase to $7,500 for plan years starting 1/1/26 and after. Really, the only change that needs to be made within that plan document is updating it to $7,500 and restating it as of 1/1/2026.
Great. And I'm glad you said in November because we had another question from Anne Maria on the same topic. Since the One Big Beautiful Bill has been approved, the contribution limit to $7,500, it doesn't show it on the IRS.gov website yet. And you're absolutely right, Anne Maria. The IRS loves to wait until late November for all of us to release the new FSA and dependent care, and for that matter, transit, parking, maximums for the following year, even if we have an idea of what they're going to be ahead of time. But yes, it's usually official at the end of November, but we do know because of that bill, it will be increased.
Yeah, so when the cost of living, the COLAs, we call them the COLAs, come out, it's usually October, November. I've even seen some of them go as far as December. Let's hope and pray that that doesn't happen this year. Really, the only ones that we're pretty sure of in terms of increases would be HSAs. Those come out in the spring of every year for the next year.
Well said. Well said. All right, we've got another question here from Nellie. I'll give my 2 cents and then pass it to you, Meredith. What sort of things flag the DOL for an audit? In my experience, a lot of times it's a former employee or current employee, disgruntled employee who contacts the DOL and says, hey, my employer or my former employer have not offered A, B, and C, for example. And that triggers the audit. Now, that being said, there could be random audits, right? Isn't the IRS out there going to businesses, for purposes of ERISA audits? What's your take on that, Meredith?
Yeah, we see audits being triggered by employee complaints, whether that be complaints to the DOL or HHS. And then we also see random audits as well. other things I've seen that trigger an audit, or at least the IRS to scratch their heads, is if you send in, say, you send in your 5,500 this year, but you were supposed to send it in for the last 5 years. If this is the first time you've done it, but you haven't done it in past years, it may make them scratch their heads and say, hey, let's look into this a little bit more. I've seen that with PCORI as well. So it's a random mix in there, but I've seen, if based on employee complaints or behavior, that the filing is happening now and it hasn't happened in the past, and then just random audits as well.
Great, thank you. Here's another good one from Sandra Ramos. On Section 125, can an employee choose to not have their premiums deducted pre-tax?
They sure can. Although I've never had anyone want to do that, which is funny. Every time I go through our POP or our Section 125 workbooks, there has to be an opportunity for the participant to opt out. And I always say, I've never seen anyone do that, but it's definitely required under the plan that they do have the opportunity to opt out. Most clients, I would say, would do an automatic opt-in, meaning that they're just automatically enrolled in the POP plan and they get their premium deductions tax-free, with the opportunity to opt out should they choose.
Great, thank you. All right, here's another one. Let's see. I don't know the answer to this one, so we'll see if you do. From Janet, I have a client that for the first time has 101 participants in their dental plan. We've sent them reminders of filing 5500s. However, they never had to do this previously. They overlooked the reminder as just a general reminder sent to all clients. Since only the dental plan exceeded the 100 threshold, will their penalty only apply to that one plan?
Depends on if it's wrapped or not. So if it's a non-wrapped plan, meaning you haven't put an ERISA wrap document in place that includes that dental plan, then you would only be submitting 5,500 for that dental plan, and the penalties would only apply to that dental plan. If you've wrapped the plans into a single document and a single plan number, then you would be penalized on the ERISA wrap plan, the wrap benefit itself. So it depends on if the plan's wrapped or not wrapped.
Got it. Thank you. All right, here's another one. Since you said you love non-discrimination testing, and you're probably the only person in the world who does, from Portia, can you give an example of the non-discrimination testing process? We could probably do an entire CE just on non-discrimination testing, but maybe in 30 or 60 seconds, you can just give a quick overview. Maybe, I'm pretty sure from my end, it's like, what do you need? Salary and ownership details, and maybe like job title. Can you elaborate on that a little bit?
I mean, there's certain tests that have to be filed. I think every third party does it a little differently in terms of the data that's being requested. Certainly from my experience, what we look for is employee level detail and then some yes or no questions. So we're looking for typically prior year and current year compensation. We're typically looking for pre-tax premiums that the employee is contributing as well as the employer. We're looking for ownership percentage. We're looking for eligibility or ineligibility in the plans. And then the questions on waiting periods and deferred enrollment and things like that. So typically it's a lot of employee data, and then there's some yes or no questions that are typically asked as well about eligibility and waiting periods.
Great.
But thanks, I could go on for 2 hours about discrimination testing. So hopefully one of our upcoming webinars.
Yeah, maybe that's a topic for next year. So good stuff. Someone asked, what if I missed one poll question? I don't think that's going to compromise your CE certificate. So don't worry about that as long as you try to answer the others. So let's see. I'm going to try to ask one or two more, and then we'll wrap this up at the top of the hour. Sure. Let's see. If the group has I don't know if this is beyond your expertise. If the group has a 401k, how many employees before 5,500 is required?
I don't know about the 401k.
We will follow up on it.
Yeah, we can follow up on that. I'm not sure from a 401k perspective. That is not my area of expertise.
Yep. All right, I'll do one last one. I think I can probably answer this one. In your experience with Ben admin systems, how are employees acknowledging the SPDs? So this capability definitely varies from one Ben admin system to another, but I have seen many of them are very customizable at this point, And at the end, it will have basically a little like e-consent, if you will, that basically has a 1 or 2 sentence blurb that, I certify that I have received and read, or I have access to, and I've received the SPDs for my ERISA qualified benefits. Something like that, where they can simply click a box or check yes, or yes, hit yes or no, and that's sufficient. So I think that's usually a good idea. But again, varies depending on the capabilities of the Ben admin system. But with that, it is 12:59 Eastern here. We had a ton of questions, like I think more than we've ever had. I see over 70 comments here. So we greatly appreciate your participation. We will get you your CE credits and your SHRM credits. We will get you the slides. So thank you everyone for being with us for this hour. We hope this was beneficial. And Meredith, big thanks to you for leading the way. This was great content.
Yeah,
So thanks for
absolutely.
sharing your
Thank you guys so much. Have a great afternoon, and we'll be following up shortly. Bye, everyone.